everybody, my name is Joshua Stanton. I'm the Mortgage Dude, and I am super excited to do another simulation for you today about the all-in-one loan from CMG Financial. This is my favorite mortgage in America, and I personally use it to multiply real estate. I help hundreds of people save money using this mortgage. So without further ado, I am going to share my screen. We're going to get into our interactive simulator. The all-in-one loan is a mortgage like none other. And if you haven't seen any of my other videos, I encourage you to subscribe to my YouTube channel, watch my videos, and ask questions because it is really important. It can save you a ton of time and money. Check me out on Instagram. You can find me all over the place. I'm not hard to find. So anyways, the interactive simulator, we built this because we wanted to compare and contrast 30-year fixed loans and other types of products to this mortgage and show people really how this works, what it's all about, get into detail. So the simulator does exactly that. It can compare any of the mortgages that you have right now to the all-in-one loan and see if the all-in-one loan is right for you or not, because it's not for everybody. There are 3 things that you need in order to qualify for most of the all-in-one loan products. Number 1 is that you must have 700 credit score or better for most products. Number 2, you generally have to cash flow positive on a monthly basis or on an annual basis in order to make this thing really work for you. And hopefully I'll do a good job of explaining that in the next few pages. And the third thing is underwriting's going to want to see some liquid assets. Money in checking, savings, money market accounts, stocks, bonds, retirement accounts, stuff like that. And if you have those 3 things, chances are really good that this could be great for you. But get in touch with me and we'll go over your scenario to see if it works. So let's go ahead and get into the simulator. There are a few things that are different about this mortgage. We wanted to show people something that could help them actually get rid of debt quicker. This is beneficial for the client, not necessarily beneficial for the bank 100%. You know, when you have a traditional mortgage, you have that fixed amortization interest schedule. The banks love that. There's a reason why it hasn't changed since the Great Depression, because it makes the banks a ton of money. But with this mortgage, instead of that fixed amortization interest schedule, there's a recasting interest schedule. The amount of interest that you actually pay is more up to you. So let me get into that in a little bit more detail. Recasting is the act of movement. So if I put $5,000 into this account today, tonight at midnight, my balance will recast downwards, and tomorrow my balance will be $5,000 less, and I will then be paying interest on that new lesser value. So it creates a snowball effect for paying off your mortgage. Normal mortgages do not do that. The second part of this mortgage that is so impressive is that any money you put into this mortgage stays liquid throughout the life of the loan and can be liquid forever. And I can show you how to do that. Just get in touch with me. So really what we do is unlock the equity that's in your house. If you put money in, you can take it out just as easy as a checking account. So if you put in $5,000 today, tomorrow that money drops into your account and it's available for you. So if the next day you need $5,000, you can just take it right back out, just as easy as a checking account. So that's how it works in a nutshell, but let me show you this simulator. We're going to compare to a new loan for these young clients. This is their primary residence. They purchased this home about a year ago. We did an appraisal, and their appraisal came in at $710,000, and their balance was about $580,000. They had a 30-year fixed loan. Interest rate was 3.5%. They were not making any extra payments or anything like that. You have the principal and interest that pops in because we've got a built-in mortgage calculator for this. Now this is a page where I start talking to the clients about what their income looks like, because that's extremely important, their income and their financial lifestyle. Those 2 things are extremely important. So these clients told me on a regular basis they make $15,000 per month together. So they make good money. One-time deposit, we're going to leave that at 0. But what you can do if you want to is put money in there. If you have money in a savings or checking account that's just sitting there, it's considered dead money. It's not working for you. It's just sitting there devaluing because of the state of inflation. Well, if you ingest that money into this product, then that money starts working for you. It starts paying down your debt. And again, it's always accessible if you need it. So you're not just overpaying your mortgage. You're actually paying this thing down efficiently and safe. And then if you need money for an emergency, or if you need money for an asset like a new house, you can just pull it right out. So anyways, we're going to leave that at 0. We're going to scroll down this page. We're going to click next. Now I'm going to talk about their spending habits. This is very important. This makes the all-in-one loan work or not. The average monthly deposits for these people, $15,000. And then from that, your mortgage principal and interest comes out, $2,604.46 for these people. And then the taxes, I'm going to change that because their taxes are about $500 a month. So their other expenses now reads $11,895.54. But for these clients, their lifestyle, after they pay for the mortgage, the taxes, the homeowner's insurance, cost about $6,645 on an average basis. So they have about 35% of their money left over after they get paid and pay for their lifestyle. That $5,250 was just going into their checking and savings account, and it was sitting there waiting for it to be spent a rainy day while they were kind of saving for their next project, which is a house. They're looking to buy a second home, and then they want to start buying investment properties. But for now, that money was just going in the checking and savings account. Okay, now we're going to click on results. I'm going to go through interest just a little bit here. So the interest on this mortgage, again, it works differently. This is not a fixed rate mortgage. This is not a 30-year fixed. That's a good thing. You're going to save money and time with this type of product. The product that we're looking at is a 1-month adjustable. There's also a 3-year fixed, then adjustable, and a 5-year fixed, then adjustable. Most of my clients choose the 1-month adjustable, but if you'd like to learn more about those other products, get in touch with me. I'm happy to go over them. We're going to change the margin to 3.5. The margin is what the bank charges, and this 3.5% does not change. But what does change is the index. The CMT index is what we have connected to this. So the index and the margin make up the initial rate. So in this instance, right now, you're closing on this mortgage, your interest rate is 5.510%, subject to change on a monthly basis. The floor rate is 3.75 and the max rate is 11.510. But with this simulator, we wanted to show people fluctuation of interest rate. We didn't want to just show you best case scenario. We want to show you hopefully worst case scenario. So what we did is connect the last 25 years of historical movement of the CMT index to this simulator, so you could see what it would look like if the inverse was true, if interest rates continue to rise instead of the last 25 years where interest rates were kind of falling. Right? So we're using an average interest rate of 5.574% in this scenario. And let me show you the graph and kind of get into interest rate a little bit more. This is helpful for people because sometimes people hear that the interest rate isn't fixed and they kind of cringe a little bit. That's a little scary. Well, there's a couple reasons why I don't think that's scary. Number one, the interest recasts and your balance recasts every time you put money into this thing. So it continuously goes down. So that's not the same as a normal ARM loan that doesn't recast. Recasting is everything. So follow up with me if you want to get into more detail about recasting because it's really important. So if you see on this graph, the average 30-year fixed rate over the last 25 years, 5.220%. The average one-year CMT index, 2.083%. You can see that the index goes up and down. Sometimes it kind of peaks hard, but goes up and down. It's cyclical. It moves. And I'm fine with that because I see that even though interest rate right now is going up, my monthly interest payment is going downwards because my wife and I are using this properly. So I teach that. I tailor it to people. I can show you exactly how it'll work for you, and we can tailor it to your financial lifestyle. So I'm going to click out of here. We're going to go back to the results page. So if these clients just wanted to pay off their primary residence, living the exact same lifestyle that they live right now, they could pay off their home in 7.6 years or thereabouts, and save somewhere around 226 grand. Not to mention what they would do to multiply their money with the extra time they have when they're not paying a 30-year mortgage. But that's not exactly what they want to do. They want to take some money out and they want to purchase some properties. So I'm going to go back to the spending page and we're going to simulate taking out money. Future one-time withdraw. They said, okay, so maybe we want to take out about $100,000 after we close on this mortgage. You can do this for a refi or purchase. But they wanted to do a refinance into this mortgage. So they wanted to take out $100,000. We just said 6 months down the line, if they found something that they were interested in, they can just take out the money. If it's available, you can take it out. So $100,000 after 6 months, they took that money out. And then they said, all right, well, we want to see what it's like to take $100,000 out after 12 months of having this mortgage. So what I'm simulating here is they've got their primary residence and then they take out $100,000 after 6 months and buy another rental property, put a renter in it. And then after another 6 months, they buy another rental property, take another $100,000 out for the down payment and closing costs. And now they've got 3 properties in a year. That'd be kind of cool, right? So we're going to save and close that. I'm going to go back out, calculate results. So this simulator is telling us that if they took out $100,000 after 6 months and then another $100,000 after 12 months, and they keep on living the exact same financial lifestyle, that they would still pay off their primary residence, which is now kind of their bank, right? They're taking money out of their home to purchase more properties, purchase more assets for financial gain. They are still going to pay off their primary residence in 9.4 years and save somewhere around 163 grand or so on that primary residence, while also getting more property. So this is a good example of how I show people how they can build wealth through real estate using this very simple mortgage tool. I can show you all the details inside and out. We can tailor things exactly to your needs. So get in touch with me for more information. Again, subscribe to my YouTube channel. Start watching my videos. Tell your friends and family. This is important. You can get in touch with me directly. I'm happy to help you. We do this product in all 50 states. So until next time, it's Joshua Stanton, your mortgage dude. Have a great day.